Picture yourself sitting in a crowded room full of investors, all competing for a chance to learn from the best in the business. Suddenly, the door bursts open, and in walks a man with a contagious smile and a twinkle in his eye. It's Peter Lynch, the legendary investor and author of One Up on Wall Street. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Don't forget to hit the subscribe button so that you'll be the first to know whenever we upload a new video. Now let's get right into the video. Lynch's impressive track record as a mutual fund manager at Fidelity Investments speaks for itself, with an average annual return of 29% during his tenure. But what sets him apart from other investment gurus is his approachable style and willingness to share his secrets with the everyday investor. Through his best-selling book, One Up on Wall Street, Lynch lays out his investment philosophy in plain language, emphasizing the importance of doing your own research and investing in companies that you understand. The book has become a classic in the field of investment literature and has sold over 1 million copies worldwide. He shows that anyone can succeed in the stock market if they have the patience and discipline to stick to a long-term strategy. So if you're looking to learn from one of the most successful investors of all time, look no further than Peter Lynch. With his infectious energy and down-to-earth approach, he'll inspire you to take charge of your finances and start investing in your future today. And that's exactly what we are going to talk about in today's video. And without further ado, here are 5 key takeaways from Peter Lynch's book, One Up on Wall Street. Number 1. The potential of an amateur. Forget what you've heard about the pros always having the upper hand in investing. Peter Lynch argues that the average person can actually come out on top. In fact, he points out that institutional investors have more obstacles to overcome than the individual investor. This may include the following. Magnitude. As a money manager's success grows, so does the amount of money they attract. However, a larger fund size can lead to fewer investment opportunities. For instance, a fund worth $10 billion would not be able to invest in a $10 million market cap company and expect it to make a significant impact on the overall performance of the fund. With clients' money on the line, a money manager's job is on the line as well. As a result, they often play it safe and stick with the herd to avoid losing their jobs. It's important to remember that fund managers have their own goals and motivations, and that they are themselves employees with uncertain job prospects. Tons of explaining. Being a fund manager involves a lot of explanation. In fact, around 25% of their time is typically spent justifying their investment decisions to different parties. However, despite the added effort, the market doesn't show any sympathy by rewarding them with an extra 25% return on their investments. Dependent capital. The capital available to asset fund managers is dependent on their clients. These managers invest their clients' money and often find themselves withdrawing funds during a market downturn and reinvesting during a surge. However, this approach is counterproductive and goes against conventional wisdom. Consequently, these managers end up with a large sum of money to invest when the market is expensive and too little when the market is cheap. Number 2. Invest in what you like. No matter your background, profession, or interests, you possess a unique advantage over Wall Street. Whether you're a retail employee, coffee lover, professional musician, technical writer, or simply a pet lover, you likely have valuable insights into a specific industry that the average person doesn't. The truth is, everyone has valuable information about publicly traded companies that Wall Street either doesn't know or has to invest hundreds of hours researching. So take a moment to consider which publicly listed companies' products you use and enjoy in your daily life. Number 3. The 6 groups of investment in stocks. There are 6 categories of stock investments, and companies can move between these categories over time, just like McDonald's has transitioned from a fast grower to a slow grower. It's crucial to understand these categories because it allows you to grasp the nature of the companies you have invested in and the reasons for holding their stock. By doing so, you'll gain a better understanding of what to expect from these companies and their stocks. This knowledge is essential when making investment decisions as it helps you make informed choices about your investments. Now, what are these 6 groups? First, slow growers. This type of business is typically massive and operates in a well-established market. Growth predictions for these companies are in the low single digits % range. These are large, well-established businesses that were once experiencing rapid growth but have since slowed down due to various factors. As Peter Lynch would say, they have pooped out. Due to their age and maturity, the market prices of these companies don't fluctuate much, which means they don't offer significant capital gains. However, they do pay out substantial dividends, making them a suitable investment option for low-risk investors who don't expect astronomical capital gains. Second, stalwarts. The stalwarts are in the middle category, and under normal circumstances, their earnings grow at a rate of 10 to 12% annually. However, if these companies experience a sudden 30 to 50% gain, it's advisable to sell them. Peter Lynch tends to keep certain stalwarts in his portfolio because they offer defensive protection during market downturns. He notes that they won't go bankrupt, but soon enough, they will be reassessed and their value will be restored. Third, fast growers. The fast growers are small and dynamic businesses that have an annual growth rate of 20 to 25%. For those who are in search of high-return investments, this is the category to focus on. However, not all fast-growing companies are the same. Lynch prefers those that are part of a slow-growth industry as they have more room to expand and capture market share. Companies like Walmart, The Gap, and Yum Brands' Taco Bell are examples of successful fast growers that are able to replicate their winning formula in new locations. Fourth, cyclicals. Cyclicals refer to companies whose sales and profits are highly dependent on the state of the economy. These businesses typically offer products or services that consumers may postpone purchasing during periods of financial uncertainty. For example, the automotive industry is often affected by economic cycles as people may delay buying new cars during recessions. Fifth, turnarounds. The turnaround category consists of companies that have been experiencing declining earnings or have been facing issues with their financial statements. Unlike other categories, their performance is not necessarily dependent on the overall market trends. The potential for profit in this category lies in the possibility of the company regaining its footing after a temporary setback, such as a tarnished reputation or financial losses. However, investing in turnaround companies can be highly risky as there is always a chance that they may go bankrupt. Sixth, asset plays. Asset plays refer to companies that possess undervalued assets that the market has not fully appreciated. These assets may include real estate, patents, natural resources, subscribers, or even losses that can be deducted from future earnings. Investing in these companies can lead to significant capital gains if the market eventually recognizes the true value of their assets. As such, asset plays can be an attractive investment opportunity for those looking for potential upside. Number 4. The 10 characteristics of a 10-bagger. Peter Lynch describes a 10-bagger as a stock investment that has increased in value tenfold, meaning that if you have invested $1,000, it would become $10,000. This is a term that Lynch coined to describe the extraordinary returns that can be achieved by investing in the right stock at the right time. He believes that finding these kinds of opportunities is the key to long-term success in the stock market. Here are 10 traits you should look for. 1. Bland or absurd-sounding company names are often disregarded, which presents a potential opportunity for investors. 2. The company engages in dull activities. 3. Lynch suggests that a company that engages in something disagreeable is even more likely to be overlooked than a company that does something dull. 4. This type of company is not owned by institutions and has not been analyzed by any financial experts. As a result, these companies have not yet been uncovered, which provides them with an additional opportunity for growth potential. 5. This company elicits a sense of sadness or gloominess, similar to Service Corporation International, which operates funeral homes. 6. The sector isn't expanding. Industries that are growing tend to draw a lot of attention from investors, which drives up prices and attracts more competitors. 7. The company has carved out a niche for itself, meaning that it operates in a specific market segment that would be challenging for competitors to penetrate. 8. The company generates repeat income through means such as subscription models or products that are consumed and need to be repurchased. 9. Insiders making purchases is seen as a good sign because it indicates that they have a strong belief in the company's potential. 10. Peter Lynch favors companies that buy back their own shares as a sign of confidence in their prospects, and he prefers these buybacks over dividends. Number 5. The 5 characteristics of the direct opposite of a 10-bagger. Inversely, Lynch also introduced the concept of a reverse 10-bagger, which is the opposite of a 10-bagger, since reverse 10-bagger is used to describe an investment that has lost 90% or more of its original value. So what are these companies that you have to avoid? 1. Industries that are in high demand are like crowded parties where everyone wants to be. However, when too many people show up, it can be challenging to stand out and be successful. 2. Be cautious when someone claims that a company is the next big thing, such as the next Amazon, Facebook, or Google. Such claims are often unrealistic and not based on sound reasoning. 3. Companies that are profitable tend to acquire diverse assets or businesses as a means to diversify. 4. When a company relies on a single customer for a significant portion of sales, usually between 25% and 50%, it puts itself in a vulnerable position where the customer has great bargaining power and can exploit the company. 5. A whisper stock. This refers to a type of stock that is often discussed in the stock market community but not widely known to the general public. It is often seen as a long shot with the potential to achieve something great, but with a low likelihood of success. Overall, Peter Lynch presents a pragmatic approach that can be customized to suit the requirements of diverse investors. His publications are a treasure trove of hands-on advice on what factors to consider while evaluating a firm and how to evaluate the market holistically. How about you? What have you learned about Peter Lynch in this video? Let us know in the comments down below. That's it for today. Thanks for watching. Don't forget to hit the like button if you enjoyed this video and click on subscribe if you wish to view more videos just like this one. See you in the next video, financial buddies!